Okay, ladies and gentlemen, first off, let me say happy Valentine's Day. We're going to hop right into it. A lot of you have been asking me more detailed questions about how I use SPX with ES, QQQ with NQ. How do I use all four together? I promise you I would drop a video. This is that video. Okay, guys? So, first, we are going to look at what I was discussing with the group on Friday. I sent out this image. This is an image of SPX. We were talking about SPX and we were showing the uptrend. We were in buys at this point, okay, guys? I said, price is still trying for higher movement. Liquidity and 50% retrace of drop are fairly strong magnets. Let's see if it can deliver. As long as trend stays intact, there's hope. The primary reason I still like the upside is we have yet to hit 2 standard deviation projections from the 1 minute, which after a good stop hunt flush and major level hit, will typically serve as good magnets, especially when paired with liquidity and 50% levels. I sent out this picture with a big red arrow showing where price was gonna go. Okay, guys, 2 standard deviation projections of the 1 minute. Okay. A little bit later, price is still moving up, looking good. And then I said, SPX is still in an uptrend, both ES and NQ above 6 p.m. open. SPX is attempting new high day here. There's no reason to attempt to short this yet. 20 minutes until noon, we want to see a run up, then a die off. And then, they smash the liquidity levels. Now, let's hop over real quick to NQ. You can see we got the run up that completed around 1240. Hit 2 standard deviation projections essentially to the tick. Maybe I was a point off, okay? And then we got the die off. Now, why am I showing you this, guys? I'm showing you this because we're talking about SPX. We're talking about NQ. We're talking about ES. We're talking about QQQ. What are we paying attention to? Why does all this matter? I want you to know that this all matters because these levels that need to hit on different assets, these are all completely different assets, but they are all looking at the same type of thing, okay? ES and SPX are the same market, different assets. QQQ and Q, same market, different assets. Most of them are tech heavy, and that's why you have the correlation, right? Because a large part of the S&P 500, their market cap weighted, is similar to the biggest players in NASDAQ 100, and that's why you see primarily large correlations, right? When tech is trending nicely. So we're talking about this because throughout the day, I'm looking at NQ and I have my levels for NQ. I also have my levels for SPX. Do I want to short NQ before SPX hits a level that is really likely to hit, such as a buy side liquidity right here? The answer is no. That's how you get trapped out, okay, guys? A lot of times, guys have trouble timing their entries because they see a level hit and they say, great, NQ swept liquidity, NQ pushed up and swept buy side. I'm ready to enter shorts. Maybe the timing is right. Maybe the timing you need to wait 15, 20 minutes. But the more important thing is, what is QQQ doing, okay? What is SPX doing? What is ES doing? You ideally want to have all 4 of these assets satisfied. And by satisfied, I mean happy with the level of liquidity that they've just, captured, okay? You don't always get all 4, but a lot of times you will get 3. So if you're looking at the markets and you're saying, okay, great, SPX hit liquidity, NQ hit 2 standard deviations, maybe it's 1:30 p.m., maybe it's 9:45 a.m., maybe it's 12 p.m. These are good macro reversal times. Then you know that when you get a smaller market structure shift on the 15 second, 30 second, 1 minute, hey, maybe you have a better chance here at a short versus you hopping in when NQ, which is usually more exaggerated to the upside and downside, maybe NQ hits a level and you say, oh, NQ hit 2 standard deviation projections. I'm shorting immediately, but maybe SPX was a little below the liquidity. In this example, that didn't happen, but maybe it did. Then you might want to wait a little bit longer because SPX will want to run to that liquidity. Now, when all this was happening, look at the Qs. 50% of the range. We tapped that. Did NQ hit 50% of the range? Let's look. It did not. It came just short, okay? But QQQ did. So the whole point of what I'm getting at right here before we dive into my specific strategies is you might miss trades because you're only watching NQ. You might miss trades because you're only waiting for SMT between ES and NQ. These signals that oftentimes happen might not happen, but maybe you're getting those same quality signals from QQQ hitting premium, from SPX hitting liquidity, from NQ hitting 2 standard deviation projections, and then you start setting up your short. Okay, guys, this is the beauty of using all 4 of these assets. Now, I'm going to talk to you. I'll try and make it a little bit brief about why SPX. I'm gonna give you the theory behind why SPX is so important. Now, if you're watching this on X, you can get a PDF summary of what I'm about to say. I'll send it to you. Just comment SPX below the video, and I'll try and DM you the summary of what I'm about to say so you can look at it, explore it on your own time, and hopefully learn and grow as a fundamental trader and not just, copying these guys, these 20-year-olds over here who are spamming evals and trying to flip accounts. Guys, the market is real. Trillions and trillions of dollars flow through this market. The whole point of my account on X is to show you that there's more behind the market than a stupid algorithm, okay? This is a real market. It's living, it's breathing. There are things happening here that are way more detailed than many of you give credit for, okay? So let's talk briefly. I'm gonna talk for just a couple minutes. Let's talk briefly about why SPX is important, okay? So SPX options are where the real gravitational mass of the equity market lives. SPX options carry the largest notional of any equity linked product by far. Now, notional value isn't cash, it's exposure. Exposure is what moves your markets. It determines the size, the weight of your overall position. So the best way I can explain this to somebody who really has no idea what I'm talking about is when you buy a house, maybe your house is worth $1 million. Many people aren't putting down $1 million when they buy the house. They're putting down 10%, 20%, 25%. So let's say you put down 10%. The amount you have in the trade, in the purchase, is $100,000. The value of what you're purchasing, the exposure, is $1 million. You're controlling a $1 million asset. That's the weight, okay? When you go to buy insurance, when you go to think about appreciation and all of that, you're using it based off the entire weight of the asset. I want you to think about notional value that way. So when we talk about how SPX options carry the most notional value of transactions in a day, think about it like that. It's in the trillions, okay? Versus ES can be in the billions, hundreds of billions. It's still a large number, but the weight of the whole equity market is thrown around by SPX because of the notional value of everything that trades there, which trickles down and influences everything else. So notional determines the influence because hedging flows scale with notional, not with the premium paid. It scales with the $1 million value of your house, not with the $100,000 down payment you're paying. So funds, insurance fund, pension funds, they don't buy SPX options just for fun. The way the market works is they buy them for their convexity and their tail protection. SPX options are the insurance market for the entire US equity system. That's the whole purpose of options. I mean, people trade options, they speculate, and people retail traders like betting on options for, earnings and things like that. But the whole purpose of options is for insurance, primarily, by far, okay? So you have dealers and speculators. The dealers, they're the ones that take the other side of that insurance. They're the ones selling these SPX options to the big funds who have humongous portfolios, okay? So these dealers, they instantly inherit what you would want to call non-linear risk. So the dealers, they don't hedge by buying more SPX options, okay? That would just add more Greeks. It would make things more volatile. They hedge with ES futures because ES is pure delta, linear, liquid, and scalable. Let me just make a quick drawing here. Kind of really lock in what I'm saying. So you have these guys, and then let's just say you have these guys right here. Now, these are your big funds, massive portfolios. Okay. What they want to do is they want to buy SPX options for protection. This is how they use the market, okay? They have huge portfolios, billions and billions of dollars worth of portfolio value that they need to protect in case the market just absolutely tanks, right? They don't want to lose their money. They buy SPX options for protection. These are sold to them by the dealers. Now, the dealers, they're in the business of just doing transactions, okay? They're in the business of buying and selling. When you think about dealers, you want to think about market makers, okay? They don't care necessarily about direction in as much as they want the direction not to mess up their hedge. They make money off of the transaction. The big funds, they want the value of their portfolio to increase over time, over decades. They buy the protection of options. The dealers are happy to sell them the options, but they almost immediately want to hedge that risk. So what do the dealers do? The dealers, they go over to the futures market. Now, with all different types of assets, it could be cattle, coffee, cheese, milk, whatever. It could be financial futures, ES, NQ. The futures market is made to hedge. That is why it exists. It's not made for speculators and day traders to be flipping things around. It's made to hedge. So the dealers, they sell options to the big funds, and then the dealers will go into the futures market because they can hedge 23 hours a day, and they can hedge humongous amounts because ES also has large notional value. They can cover all their exposure easily. So the dealers go to futures markets to hedge. This is the flow, okay? So let me get back to, I have some notes here. Let me get back to sort of like where I was in my notes. So SPX creates the risk. ES neutralizes the risk. And that's the core ecosystem of what is happening here, okay? So when SPX gamma shifts, then ES will move and the entire equity market follows. So in summary, the funds buy SPX options for protection. The dealers hedge with ES. ES moves the market. This is why SPX options effectively run the equity market, even though the premiums are tiny relatively. Small dollars create huge exposure. Think of our $100,000 house down payment versus the $1 million asset value. That huge exposure forces huge hedging flows. So in a nutshell, in modern markets like we have today, the price you see that moves daily, it's often a reflection of the hedging mechanics that are going on and not fundamental buying or selling. This is really why you guys might think, okay, there's an algo driving the price. It looks like it's stair-stepping up. It's doing all these things that appear algorithmic. It's the dealers hedging. When you see ES just flowing around up and down, dealers do not care about direction. They care about, are they hedging, because they've already made money on their transactions, okay? The dealers aren't simply trying to ride price up and hold forever. They want to be delta neutral, okay? To the best that they can be, and they want to hedge their gamma. So guys, I know for a lot of you, this might have gone over your head. This might be a little bit more complicated than you were thinking. Like I said, if you're watching on X, comment SPX down below, and I will send you a PDF that summarizes this part of it, the video, and then you can dig into it deeper on your own time. And right now, I want to hop into the strategies of actually using SPX, which is what most of you guys are here for. So we've got a few strategies that we're going to look at here. Let me kind of paste these here. All right. So we'll kind of keep referring back to this. Now, when you are looking at SPX, we're going to primarily focus on SPX because I just told you the notional value. SPX is the big Mac Daddy of the market, of the world. Okay, guys, it's not QQQ. It's not NASDAQ. It's definitely not NASDAQ. It's not even ES. It's SPX. So when we're sitting here watching SPX, we have these key strategies that we're going to kind of walk through. Now, the first one is what I call a 25% retrace. Now, the way I have my chart set up, I give full credit to one of my good trading friends who a long time ago walked me through how she views SPX, how she charts it, and everything in trading is passed down. You know, somebody passes down to her. She talked to me through it. I saw how effective it was. And I love taking things that work from other traders. But I am not sitting here inventing new ways to trade, okay, guys? I am sharing things that work, things that have been passed down, okay? So the 2-minute chart is how we do our gaps. This part is very important. When you are looking at a gap, we're going to go to this big purple gap here. You are taught by many people to look at the close of the previous day and then to look at the open of the next, okay? So that would be like the close would be here and then the open would be at the start of this candle. What we find that works 95% of the time, if not more, as a better tool for measuring the gradients of your gap. Go to a 2-minute chart, not a 1 minute, not a 3 minute, not a 5 minute, not a 15, a 2-minute chart. The market opens up at 9:30. It could go up or down after that first candle forms. So at 9:32, you're going to have that first candle. What you want to do is place your gap as the bottom of your gap at the bottom of that 9:30 candle, or the top if it was a market that was going down. Okay, so you already will have the close. This little it's always kind of a little like line here. This is always going to be the starting point of your gap. You wait until 9:32 to see what this candle does. If this candle right here pushed down at 9:30, then at 9:32, my gap might be like about here. Okay, guys, let me repeat, I am not using the open 9:30 price. That is not how I do my gradients, and I encourage you to do it the way I'm doing it, okay? 2-minute chart. So now that we know how we're drawing our gaps using the 2 minutes, waiting for that first 2-minute candle to form, and then we're getting that space there, this is what I call my opening gap for SPX. I do the exact same thing for QQQ as I do for SPX. Now, the first strategy that we have is 25% retrace. So let's take a look. Hey guys, if you've made it this far and want to learn more common sense ways to beat the market, come join our Furu University Discord. We provide daily analysis for the most popular markets and have a friendly group of traders who trade everything from ICT to supply demand to order flow to volume profile. The learning curve for trading is pretty steep. Let us help you beat the markets. You can find the link in my bio on Twitter and on YouTube. Okay, back to the video. Here's an example, just, a random day that I went to. This is January 27th. You can see here that who cares what ES and NQ are doing right now? We're talking about SPX. How can I use this to identify when a level is satisfied, when the market is happy? So here we are, and SPX, initially opened up right here at the top of the blue candle. At the end of 9:30, at the 9:32-minute candle, start of 9:32. You can mark your bottom right here. This is your gap, okay? And you can see this is a great example of how I'm drawing the gap at the bottom of this first 2-minute candle. So SPX drops down. One common thing that SPX loves to do is drop down to the 25% level. Now, when you have a support below you, maybe it's an OTE retrace. Keep in mind, the Globex session for ES and for NQ, it goes 23 hours, right? It's overnight. So we have RTH, ETH, and these all play together. So in RTH land, you might get a little drop here to 25%, but maybe over in ES, you're getting a much bigger sort of like OTE retracement of some strange overnight range. By looking at this, you can say, okay, look, the market tried to push higher and it couldn't push higher. The first level I want to see it reach is 25% before, let's say we're bullish on the day, right? I have no idea what was happening on this day. Before we rip up, for whatever reason, SPX hitting 25% means it's happy. It is satisfied. Many days you will see SPX, pop up at open right here, just a little pop, drop down to 25% of the gap the way I draw it, and then get a strong reaction, okay? That's one example of how we can use SPX. Now, let's hide this. The next was 50% gap levels. So let's go over here. Check this one out. Here we have a drop on SPX. Now, Keep in mind about how I'm drawing the gaps here. We wait for the 930 candle. It goes at the top because we opened up down, right? So you can see, I think you guys are starting to get it. You can see how I'm drawing the gaps here. SPX initially pushes up. Now, like I said, ES, NQ, they might be pushing up to some overnight liquidity, okay? Because this in between this gap is all the overnight. They could be pushing up to an overnight liquidity. They could be pushing up to, a London high. They could be pushing up to an OTE. Who cares? We're over here looking at SPX. And look at the reaction you get here from 50%. When you cross through the 25, depending on what NQ and ES are doing, you can drag, SPX, in my opinion, controls everything, but you want all the markets to be happy, okay? So 50% is a very, very common level that SPX likes to hit before you get some type of reaction. Now, when we think about things like the silver bullet, like I'm not a big fan of the silver bullet at all, because as markets start getting chopped, a lot of traders get chopped around 10 a.m. time, right? But look at the time here. At 9:50, we're pushing up. We're pushing up into some level on NQ, into some level on ES. Here on SPX at 9:50, we're pushing right up into 50% that we touched at 9:45. And for me, 9:45 time is one of my favorite morning time shifts. I've been teaching you guys about this for the longest time. People do not give enough credit to the 9:45 reversal. And then right here at 9:50, where we start pushing down for the move that extends down into, the 10:30 move that, maybe if London was dropping down all night, you can always get that move down for till 10 or 10:30. And then you might be out of the trade. You might be done. Because something like this is a 1% drop, massive 70 points. And at that point, you could be done for the day, okay? So the second strategy that I want you guys to look at is if you get that initial move and retrace up to 25%, but you still have NQ and ES levels higher, then you can look at the 50% level for reaction. That is if you start dropping off after 50%, you should feel very good that the market isn't going to do some weird move to just sort of like keep blasting higher, okay? Especially if you have a bearish bias, especially if the other three assets are happy. Now, let me show you another example of the 50%. Here we go right here. And you can see how when I draw these 2-minute levels, this one happens to be pretty much right at, the open. You're getting very accurate touches, okay? And that's one of the beauties of SPX is when you sweep liquidity, it doesn't exaggerate, okay? We all have experience, right, of ES, of NQ, hitting liquidity, and then you're frustrated because you're like, man, I just swept liquidity, but it's kind of edging higher. When's the real move gonna happen? They're doing 3 different fake outs on the up move. SPX almost never does that. The levels that are formed from RTH time are very, very nice where they're snappy. When you hit that level, you can get in with a tight stop because you're like, okay, cool, we hit 50% or we swept some liquidity or whatever. I don't expect it to keep running blindly unless that's the direction of the trend, okay? But if you want a reversal, SPX doesn't mess around. It hits a level and it reverses nicely. So here you go, another session where at 10 o'clock, you get the reversal. This would be a good silver bullet trade. From the low coming in at 10:02, and then you start pushing back higher. Who knows what NQ and ES were doing at this point in time? But whatever they were doing, I guarantee you they hit some level, and then now you're getting a push up. But with SPX being happy, with SPX determining the overall movement of the market by and large, you can feel very good at this rejection of 50% with that push higher. And then maybe you want to hop into a trade right here. Now, we also have, let me see here. We also have what I like to call inverse levels. Let's go to this. One thing you will see oftentimes. And this is across 2 different days, right? Because here's another little gap here. When the market was up here and it dumped down, when the market was here, dropped down hard on this day. As the market is moving higher, these inverse levels You have inverse OTE right here, the 61.8, the 70.5, but look at what it does when it goes up to 25%. Now, there could be other reasons here. You could have volume here. There's a little bit of a consolidation here. But oftentimes when the market flips a gap and then it reverses back up into it for a further drop down, right, as part of a trend, higher high, then you have a low here, a lower low, and then you got a lower high, and then you're going for another lower low, this downtrend that's happening here. If you see SPX push back up and you're getting a strong reaction off of a level like 25% of the gap from the inverse side, then that's a really strong indication that, okay, we might really be making a move here. That's a strong point that I can get in for a sell. Like I said, who cares what NQ and ES are doing at this time? We're looking at SPX. All of you guys know how to find levels on ES, how to find levels on NQ. What the point of this is when you hit those levels on NQ or you hit those levels on ES, you can look to see what SPX is doing. Where is SPX reaching for? Okay, guys, this is what you call an inverse level happening here. One of the other levels that I love to watch, I just don't have an example pulled up right now, is OTE. So the exact same way that you see the drop from the previous examples into 25% or into 50%, you can drop into OTE. Typically, I like to see drops into OTE after you get a nice expansion away and a level hit. So if the market might be bullish, I would rather prefer a quick drop into 25% or 50% and then expansion. But if the market goes up, hits a liquidity level on SPX, then we want to see a deeper move into the gap. So I don't love to see immediately, like this right here would be an immediate run through the gap. I would prefer that the market hit, and we're going to talk about this level right here, but I would prefer that the market hit some liquidity like it did here before it runs down and just demolishes a gap. So a lot of times after a liquidity sweep happens on SPX, you can then target, especially if the gap has not been touched or has only been touched 25% before the run up, you can then start targeting the 50% and the OTE levels of that gap as beautiful magnets for price, okay? So that's the OTE type strategy. And then we also have the SPX liquidity level strategy, which I won't even call it a strategy because this is more what I consider common sense. So a lot of what we do with SPX, you can see here, there's a high here, right? And I have it labeled SPX liquidity. On this particular day, let's zoom in a little bit. On this particular day, you got a immediate run up and you tapped SPX liquidity. A lot of what we've been talking about today has been gaps. Gaps are a fundamental part of trading QQQ and SPX because you don't have the overnight session, the Globex session. It's all RTH. So you're looking at liquidity levels. These are going to be RTH liquidity levels. Now, some people will go on ES and they'll turn off ETH. They'll go to RTH and then they'll say, okay, cool, let me find my RTH levels. I encourage you to use SPX and QQQ for all of your RTH levels. These are the real levels that markets want to hit before you can get a strong reaction. What I want you to notice here, look at how we took that liquidity and we did not. SPX does not do this. We did not get some crazy run up where you took the liquidity and then went like this and then faked out again and then, faked out again and then came down. SPX doesn't do that. ES and NQ do, especially NQ, right? Like NQ loves to fake you out, stretch a little too far, rebound. ES doesn't do it as much, but it still does it. If you want to get very nice timed moves, okay, then we can use SPX because when it hits that 25% of the gap, when it hits the 50% of the gap, when it hits the OTE of the gap, when it gets to a gap fill, which is what we saw the other day that got us into the longs, when it hits liquidity, the levels are snappy. They're sharp, okay? This is one of the primary benefits of using SPX and alternatively QQQ as well. But QQQ is a little more bleedy, okay? So when we're talking about gap fills, this is another part of our strategy. I don't think I had this written down. Let's see. Yeah, I do. So 25%, 50%, OTE, gap fills, RTH liquidity levels, inverse gaps. We talked about all of these, and now let's look at the gap fills. Now, because I didn't want to try and dig up really old price action, I've been using, these are all very recent examples of SPX interplaying with these gaps. Look at this. This is why I was bullish on Friday. This is why we smashed the longs. I got long from down here on NQ. I was long from way at the bottom. It was beautiful. What I'm looking at here, we had been talking about this on X a little bit before. We had this whole drop down. This gap that I showed you previously on X was untouched. The way, look at how we took off here on February 6th. It was untouched, which makes it a huge magnet for any other drops, okay? Not looking at NQ, not looking at ES, strictly looking at SPX. We know this is a magnet on a day that's heavy sells, okay? So we came down and we tapped it on the day before, right? So on February 12th, we tapped it. And that was, you guys all saw me kind of calling out, this was my final destination for this in conjunction with ES hitting the 4-hour untapped fair value gap and NQ reaching down. I was 15 points off on NQ after a multi-100 point run, hitting the untapped fair value gap on the 4-hour. So we came down, we tapped the gap. Now, on Friday, what they did was they pushed down. Why was I confident? I was talking to somebody on X the other day, and they talk about getting in the manipulation phase, et cetera, et cetera. Why was I confident getting into longs so low? Here is why. And this is where we're going to talk a little more detail about the interplay between all of them. Like I said, you guys all know how to find support resistance levels on ES and NQ. When the market is moving down, I knew that gap fills are very reactionary for SPX. So by default, when you fill a gap, you want to get some type of pop reaction, especially when you might be bullish on the day. I was bullish and telling the Discord to be bullish because of CPI. CPI came in low. We had a really strong jobs report earlier in the week. The whole market is thinking about interest rates and rate cuts, and anything that can potentially promote more of a rate cut will at least temporarily be bullish, okay? All of the guys who are on the Fed, they have been saying, look, we feel pretty good about the jobs market. We're watching inflation. Inflation is still running hot. And so any type of indication that, oh man, if the guys are like, well, we really want to have a reduction in rates. If you don't see inflation coming down and a lot of Fed members are watching inflation, then that's really bad for future rate cut potential, right? So when the CPI came out and the inflation dropped to a nice level and the jobs report came out and it was strong, that's what you wanted to see to say, okay, look, maybe we actually have potential for more rate cuts than they think if inflation actually keeps coming down. That's kind of the thinking of the market. So on Friday, I'm sitting here and I'm bullish. And so when I saw that big flush, for me, that was a gift because on SPX, they flushed down just to the bottom. I mean, guys, look at this. Look at this, guys. Just to the bottom of the gap. It went 3 points beyond the gap. That is amazing for you to time along. What was NQ doing at the time? NQ was coming down, sweeping. Let's put up our sessions. NQ had already come down and swept London, right? Got a bounce up. It was going for a third sweep because we had a little sweep here. It came down and swept more liquidity. But remember from my video earlier, or posts, this green box was a 4-hour untapped fair value gap. If you are to remain bullish, you want this to hold. We know NQ bleeds a little bit through levels. So here we are, SPX filling a gap. Here we are, NASDAQ just punching below and forming a doji candle with the untapped fair value gap. Here we are with, let's look at the, what was it right here? If we draw out the projections, look at this, 2 to 2.5, what I teach you guys, holding, guys, 2 to 2.5 holding from the drop down. This is what I call inverse projections. When you're looking for projections for the retrace to go the other way, you draw inverse projections, guys. 2 to 2.5, just wicking below the untapped fair value gap. Okay. Oh, what's ES doing? Let's take a look. ES is hitting down into a support level. Oh, what support level, guys? What support level are we talking about? Look at this. I had shown everybody. I said this. Let me really make it clear for you guys. I said this level here will serve as support to prevent a drop down to here, at least for now. I'm not sitting here saying the market's going to blast up. Nobody knows. I haven't done my analysis yet for the weekend. But as I'm going here, this is a reactionary level as support. This is something that I will teach you guys about later. Kind of the retail head and shoulders pattern as it relates to a smarter approach to trading. But this is a support level. So at the same time, we had everything else happening with what I just showed you. You have ES, S&P, SPX just wicked below that gap. And then ES is in the support zone where I am thinking if you go below that support zone, it is bearish for the day. Okay. You need to have levels where you say, if NQ goes below the 4-hour untapped fair value gap, if ES goes below this huge higher time frame support level, okay, if SPX goes below the gap, it is bearish. So if you are going to be bullish, if you are the market going to be bullish and have any sort of order at all, the asymmetric risk offered to you from entering long right here where I did on NQ is amazing. Okay, guys. And then you also had a really strong volume spike on the 5-minute that happened right here. So the point of all of this, and let me just, because we're showing everything, let me just show you QQQ on this particular day. Very similar gap, very similar. Now this gap was not untouched like SPX, it was partially filled. Where was it filled to? Well, let's take a look, guys. This works on both. Here's a 25% level. Where was the gap drawn from? The 2-minute candle, the bottom of it down to the top, not the close, the top of this other candle. On this particular day, which was the 6th that we talked about, this is QQQ, you drop down to 25%. Okay, we're looking at the same levels, the same techniques. So the SPX gap was untouched. The QQQ gap touched 25% and then it expanded away. So on this particular day, I drew this out as a gap fill, but we knew it wasn't untouched. So NASDAQ QQQ had an exaggerated move like it always does. It's a higher beta asset, okay? Had an exaggerated move with a sharp snapback because it didn't want to go lower. So when you are sitting here, let's go back to the SPX with what I had listed. And then we're gonna kind of start to wrap this up. When you're sitting here and you're looking at your levels, okay, you need NASDAQ. First of all, you need to know how to find good support resistance levels, okay? That's key. You're looking at the NASDAQ 100 futures, NQ. You're looking at the ES mini, ES. A lot of you guys look at both, which is smart. You're looking for SMT and you're looking for your support resistance to hold. By adding into what you are already doing and looking at the 25% retraces, 50% OTE and gap fills for SPX and QQQ daily gaps, and looking even more importantly at the liquidity levels that might be targeted on QQQ and SPX, you can hold your trades just a little bit longer. You can miss out on being faked out by waiting just a little bit longer until these levels hit on SPX and QQQ, okay? That is the whole point of all this. SPX runs the market. The dealers hedge with ES. NASDAQ 100 and QQQ have far less notional value and weight than SPX, okay? So if you had to pick one of the 4 of these to really look at, I would encourage you to look at SPX. But we all trade futures, okay? So you're already looking at NQ and ES. I want you to put most of your focus and attention on SPX. But when all 4 of these have satisfied some criteria, which usually is a certain portion of a gap fill or liquidity, then and only then can you look for a potential reversal if the timing is right and if the global narrative makes sense on that particular day or for that particular week, what have you, okay? So this is how you use SPX. This is how you draw your gaps. And this is everything I do to identify real turn points within the market. And it's how it works, guys. The very last thing I will say before the video ends is, just like when you're looking at retraces on ES and NQ, and you're drawing kind of your 50% retrace of the swing or of the day or whatever, right? Do the exact same thing. High up here, down to the low down here, draw your 50%, and then see what happens. And I already talked earlier about how we hit 50% on this level. If you're in a trade and you're long, when any of the four hit a level that carries weight, liquidity, 50%, a destination, okay? You need to partial your trades. At a bare minimum, what can happen is you'll get a deep retrace before it gets forced back higher. And in the worst case scenario is you get a full blown reversal. Okay, guys, if you were sitting here and you were watching SPX and you demanded SPX take liquidity and hit 50%, you got screwed, right? But if you were watching NASDAQ and you say we hit 2 standard deviation projection, and you're watching QQQ and you said QQQ retraced 50% of the entire drop, now you're thinking, let me take off 50%, 75% of my position and trail the other 25% for that last little bit. Me personally, I was out at liquidity. In all honesty, I was out when we got right here, just below liquidity. I don't care about that last few ticks, guys. I use these levels as magnets that I know they're going to hit. I know there's an 80% chance my levels hit, but I trade to the level. I don't need to trade through the level. That has saved me. My levels are so precise. Oftentimes I will miss out on huge moves by 1 tick. It happens almost once a week, where the precision is just too extreme, where by 1 point or 1 tick, my limit orders aren't being hit, my take profits aren't being hit, and then you have to sit through a retrace. Okay, guys? So my last tip for you guys, you know what levels to look for now. Wait for more confirmation. Wait for 3 out of the 4 assets to be happy and satisfied, liquidity taken, gap levels hit before you take the reversal, or partial when 1 out of the 4 assets is hitting a level, because you will most likely get some type of retrace happening that you probably don't want to sit through, just to get that last 2% of the potential out of your trade. Okay, I hope this helps, guys. I don't know how long this video is, but these are the techniques that you need to be using in the market, especially with all the chop, to give yourself that edge to really hold on to trades longer and to wait patiently before you get into trades, so that you are not taking 2 or 3 stop outs before the market actually starts going in your favor. All right, that's it. Like I said, have a good, happy Valentine's Day. Hope you guys go on some good dates, and I will catch you throughout the week. All right, see you.